Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we'll have a look at the latest high-frequency indicators with regards to global and U.S. growth. We'll have a look at U.S. trade ahead of the July 9th update to Liberation Day tariffs. We'll have a look at European inflation. And finally, in South Africa, we'll have a look at what's been happening for inflation expectations in South Africa, the trade balance, and government revenue. We're going to start off with the latest high-frequency indicators with regards to global growth. The latest S&P Composite PMI series ticked up to 51.7. Any number above 50 indicates a month-on-month expansion in global economic activity. Any number below 50 indicates a contraction. 51.7 is a pretty normal number, and it suggests that global growth last month accelerated up to around about 2% or so. And it is quite remarkable how steady global growth has been despite all of the elevated global economic uncertainty. If we look at individual countries, most of the countries that we track had PMI readings above 50, and most of the countries that we track had PMI readings above last month, suggesting that there'd been a widespread improvement in economic activity last month. There is just one nuance, though, and that is of the countries that had the biggest increases in PMI readings last month. It's China, it's Europe, it's the UK, it's Japan. They're non-US countries, suggesting that we saw quite material acceleration outside of the US, while the US remained relatively stagnant. And that is broadly consistent with the changes to consensus forecasts we've seen over the past year or so, where there's been increasing concern around the US and increasing optimism around some of the prospects for non-US economic activity. And a month is a short period, but it is interesting that we're starting to see that pan out in the high-frequency economic data. If we dig a little into the US data, there was one particularly concerning point, and that's the US's services prices paid series. And this series remains pretty elevated, and there's a very strong correlation between this series and US inflation 4 months later. On the basis that this number has remained elevated, we should probably be penciling in acceleration in US inflation over the coming 4 months. And that's before we hear on July 9th what the latest tariffs are likely to be. And this would be quite problematic for the Fed. It puts them in a tough spot. As we're seeing some signs of US economic stagnation, we're also seeing signs that inflation is remaining pretty sticky. Sticking with the US, July 9th, we should get an update of Liberation Day tariffs. It's not immediately clear what the implementation date for these tariffs will be. It seems like there will be a set of countries where there will be an announcement, hopefully as soon as today, and those tariffs will be effective from the 1st of August. But there's also a range of countries that won't meet that initial threshold, and they may well receive tariffs similar to Liberation Day, but we're not sure when they kick in. We've seen some indications it'll be 1st of August, some indications it'll be the 1st of September. And of course, things could change at the last minute. There could well be a postponement, or there could be other changes, like we heard over the weekend that President Trump is looking to impose an extra 10% tariff on countries that align themselves with the BRICS. So it's very uncertain at this point. We'll just have to wait and see. It is adding to broad economic uncertainty, market uncertainty too, and hopefully we'll get clarity in the near term. In the interim, the US economy continues to just chug along. Last month, 150,000 jobs were added, which is roughly in line with the month before, and that was enough to see the unemployment rate dip slightly. And it's a pretty good number. And it's quite remarkable how the US economy has just continued to add jobs despite all of the uncertainty over the past year or so. The consensus forecast is that the US market is going to slow from now, though. The Q3 average for non-farm payrolls growth is materially below the Q2 average. That's based on consensus forecast. So it is something we'll have to keep a close eye on. And this is something that the Fed is concerned about too. Switching to Europe, European PPI inflation is sitting at around 0%, which suggests that there's some downside to European inflation ahead. Quite a different story from the US. And if you look at the latest CPI numbers, which came out last week, European inflation is sitting at around 2%, so in line with the ECB target. Now, given the cuts we've already seen, it's not likely that we're going to see a cut in July from the ECB, but the market is pricing in a 50% chance of a cut as soon as September. There we likely see a further disconnect between European monetary policy, which has seen quite sizable cuts, and the Fed, which is not really in a position to be able to cut now. And finally, in South Africa, we had some encouraging inflation expectations data come out last week. And current broad-based inflation expectations are that inflation will be 3.9% this year. That's the lowest we've seen in some time and well below the SARB's current target of 4.5%. They are looking to shift that target to 3%, so it's not clear the scale of cuts that this allows, but nonetheless, the encouraging development is that inflation expectations are declining, and that does allow for them to at least cut sooner rather than later. Similarly, some encouraging data on the export side of things. The South African trade balance ticked up again. The trade balance last month was north of 20 billion rand, and that was due to a quite material increase in export prices. And that leads to greater revenue for South African exporters, greater profitability, and ultimately more revenue for the South African government. So we'll watch this space closely, but it is nonetheless encouraging. And just on government revenue, employee tax receipts continue to be quite strong, up 7.5% year on year last month, suggesting that formal sector income growth continues to be strong. And in addition to that, total government revenue looks at this point to be running ahead of budget. It is very early days. It's only 2 months into the financial year. Our model at this point suggests that total government revenue will be about 60 billion rand above the budget forecast in February. That would mean that there's limited need to increase taxes, but it is important to note it's very early in the financial year. There's a wide band of uncertainty around that forecast. We'll be able to narrow that uncertainty a little bit once the June numbers come through next month. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.